All right, let's dive right into this explainer. Look, if you've been anywhere near the financial news lately, you've definitely heard the term private equity thrown around. And honestly, it's not just on Wall Street anymore. From the hotels you stay in and the apps on your phone, to your local hospital network, and yeah, even your own retirement fund, private equity firms like Blackstone, KKR, and Apollo are literally everywhere. But how exactly did they go from being this obscure niche player on Wall Street to the unseen engine running our modern world? Well, today, we're going to unpack exactly how these firms, which, by the way, collectively manage trillions of dollars, became the true masters of global capital.
And hey, don't worry if high finance usually seems a bit intimidating. We've got a very clear roadmap for this explainer. We're covering the invisible economic engine, the private equity playbook, triumphs and tragedies, strategies beyond the buyout, your life on private equity, and finally, the future of capital.
Okay, starting off with Section 1, the invisible economic engine and the shift in global wealth creation.
To really wrap our heads around the massive amounts of money managed by these modern financial empires, we actually have to take a step back and look at how capitalism itself fundamentally transformed. It's like a tectonic shift. We moved away from an era of building physical empires to an era where wealth is essentially generated by restructuring ownership. Think about the industrial era. That was all about tangible things, right? Industrial moguls like J.P. Morgan and John D. Rockefeller, they consolidated massive industries just to control physical production. We're talking factories, railroads, oil fields, the whole shebang. But as we rolled into the late 20th and 21st centuries, we entered the financial era. Wealth creation completely changed. It wasn't just about making physical goods anymore. It became a game of capital allocation, asset optimization, and pure financial engineering. Private equity basically mastered this new world. They realized, and this is key, that you could unlock immense value just by redesigning how companies are owned and structured.
So you're probably wondering, how did they get so much cash to play with in the first place? Well, picture this. It's right after the 2008 financial crisis. The world is suddenly dealing with historically low interest rates across America, Canada, Europe, everywhere. Traditional bonds were offering incredibly weak returns, and the public stock markets, absolutely entirely volatile. So you've got these massive institutional investors, think massive sovereign wealth funds and huge university endowments, and they realize public markets just aren't cutting it for their long-term goals. They were literally starving for higher yields. And private equity, they stepped right into that vacuum and were handed trillions of dollars in fresh allocations.
Moving right along, Section 2, the private equity playbook and the anatomy of a deal.
There's this deceptively simple four-step playbook that acts as the blueprint for almost everything these firms do. Step 1, they raise capital. They pull billions from those big institutions we just talked about into a fund that's usually designed to last around a decade. Step 2, they go hunting for undervalued or inefficient companies and acquire them. But here is the absolute secret sauce. They don't just use the cash they raised. They borrow heavily to make the purchase. Step 3, they step in, roll up their sleeves, and improve the company. That could mean restructuring operations, swapping out management, or just hitting the gas on growth. And finally, Step 4, years later, they sell that company at a much higher valuation, hand massive returns back to their investors, and of course, keep a very hefty cut for themselves.
Now, the crucial engine driving that whole playbook, it's called the leveraged buyout, or LBO. Frankly, this is one of the most powerful financial innovations in history because it lets them scale up acquisitions immensely without needing a ton of initial cash. Think about the logic here. It's fascinating. Instead of buying a company outright with cash, the private equity firm borrows heavily to buy it and then, get this, places a huge chunk of that debt directly onto the acquired company itself. It's kind of like taking out a mortgage to buy a house, but then forcing the house to pay its own mortgage from its own income. Because the firm uses only a tiny fraction of its own money, any successful growth in the company's value magnifies their profit exponentially. It's brilliant, but it's intense.
But leverage? Yeah, it's absolutely a double-edged sword. Section 3, triumphs and tragedies and the duality of leverage. $14 billion. Just let that sink in for a second. That staggering number represents Blackstone's reported profit from their legendary 2007 buyout of Hilton Hotels. This deal is basically the ultimate triumph of the private equity model. Blackstone bought Hilton for about $26 billion right before the global financial crisis absolutely devastated the real estate market. At the time, analysts thought it was a complete disaster, but Blackstone didn't panic. Instead, they fundamentally restructured the entire business. They aggressively moved away from actually owning the physical hotel real estate and pushed hard into global franchising and brand management. They made it scalable, they made it efficient, so when they eventually took Hilton back to the public markets, it resulted in one of the most profitable private equity deals ever recorded. It's a perfect example of how they can create incredible long-term value through strategic operational transformation.
But, flip the coin and you get the Toys R Us collapse. This shows the absolute devastating consequences when extreme debt burdens just consume a company. Acquired back in 2005, Toys R Us was saddled with massive debt from its leveraged buyout. So instead of using its cash flow to invest in, say, e-commerce and fight off emerging threats like Amazon, the company was forced to divert its money just to pay off the massive interest and fees on its own buyout debt. Literally suffocated by this burden, they just couldn't adapt. They eventually filed for bankruptcy, closed down those iconic stores, and it resulted in massive job losses. And honestly, this tragedy sparked intense and still ongoing debates across America and Europe about whether the private equity model sometimes extracts value at the dire expense of workers and local communities.
Which brings us to Section 4, Strategies Beyond the Buyout. Let's look at the broad ecosystem of private capital.
Because private equity really isn't just one single strategy. Beyond the high debt of the leveraged buyouts we just looked at, there are entirely different flavors making up this financial ecosystem. Take growth equity. This is where firms buy minority stakes in successful, fast-growing tech companies to help them scale globally, and they usually take on very little debt to do it. Then you've got venture capital. This is the Wild West, the high-risk frontier targeting startups. The firms know most of these companies will fail, but a few massive hits will cover all those losses. And finally, distressed investing. This is where firms buy struggling or downright bankrupt companies at steep discounts. Now, supporters will argue this provides the operational discipline needed to save companies from total collapse. But critics, they argue it leads to severe cost-cutting and job losses, which naturally sparks some really fierce ethical debates, especially in regions with strong labor protections like Europe and Canada.
Speaking of venture capital, it actually gave us the modern tech era. I mean, they funded revolutions like Google, Facebook, Airbnb, Uber. But because the whole model relies on asymmetric returns, there is this extreme tolerance for risk. And sometimes, actually, scratch that, a lot of times, this fear of missing out completely distorts rational financial analysis. I mean, just look at the spectacular, very public collapses of FTX and Theranos. Fast forward to today in 2026, and we're witnessing a massive investment frenzy in artificial intelligence. Private equity and VC firms are aggressively piling into AI infrastructure, cloud computing, robotics. Sure, this tech disruption creates enormous profit opportunities, but it also concentrates a ton of capital around the hype and narratives of future growth rather than proven stability. And that, for sure, increases systemic risk.
Now you might be thinking, okay, this is all just abstract Wall Street math. But Section 5, Your Life on Private Equity, takes this straight from Wall Street to Main Street.
Let's connect this directly to your everyday life. Private equity is literally the unseen landlord of your apartment building, the backer of your local hospital, the engine driving your retirement fund, and the financier of tomorrow's technology. Think about your retirement. Pension funds rely heavily on private equity returns to support aging populations. That means your future security is directly tied to how well these guys perform. Housing. Huge investment firms now own enormous residential real estate portfolios, which is pouring gasoline on the debates over rent inflation and affordable housing. What about healthcare? Private equity ownership of hospitals and clinics is expanding incredibly fast, sparking arguments over whether it actually improves efficiency or just prioritizes short-term profits over patient care. And the tech and renewable energy that will define your future? Largely financed by these private capital ecosystems. They aren't just buying companies anymore. They are fundamentally redesigning the plumbing of how capital flows through our entire society.
So as we look at the massive influence of these diversified empires, we have to ask, where's this all heading? Section 6, The Future of Capital, Innovation versus Regulation.
Honestly, the future is going to be defined by a massive high-speed collision. On one side, you have private capital aggressively chasing AI and climate profits. Firms are already using machine learning to find acquisition targets and optimize supply chains in ways we've never seen. They're also mobilizing trillions to capitalize on the massive government push toward renewable energy in the climate transition. But on the other side, the watchdogs are finally waking up. Regulators across the US, Canada, and Europe are now deeply concerned. They're looking at monopolistic concentration, the systemic financial risks from all that leveraged debt we talked about, and the very real social impacts on housing and healthcare costs.
The next era of global capitalism is absolutely going to be defined by this intense clashing tension.
And as this unbelievably powerful tool continues to redesign our global economy, this is the profound question we all really have to ask ourselves. Private equity isn't inherently heroic, and it isn't purely destructive either. It's just a tool, an extraordinarily powerful, deeply influential method of capital allocation. Yes, it has the power to create immense prosperity and fund the next technological revolution, but it also has the power to create deep instability and inequality. Its ultimate impact? Well, that depends entirely on the incentives and the vision of the people who wield it. As we move deeper into this highly financialized, AI-driven future, the influence of these masters of global capital is only going to grow. The real question is, how will we shape the rules they play by? Thanks so much for joining me on this explainer, and remember, keep questioning the systems running our world.